Why can't Bitcoin just break through the 70,000 mark? Short-term funds are flooding in while veteran players stay put. The giants are adding to their positions even at a loss. Do you think this wave is about to take off, or is it another harvest? Tuesday, April 7th. This is BTV Chinese channel, CoinChain. I'm Michael. Some people ask why I emphasize the Chinese channel. Well, many don't know that our shows are broadcast simultaneously in Vietnam, Japan, Korea, Thailand, and Spanish-speaking regions, using local hosts in their native languages. You can search below our channel to find links for each language. All right, let's look at today's must-watch crypto data headlines. In this wave, Bitcoin knocked on the $70,000 door in the last 24 hours. Just missing it, right? It rose 4.4% in 24 hours. But if you're a gold member and saw Monday's review, I'd tell you something feels off, right? It seems more like leverage and sentiment are pushing the price up. You have to understand, the situation in the Middle East hasn't stabilized yet, so the market is very jumpy. However, on-chain data is very real. Most of the funds rushing into exchanges now are short-term, under 6 months, accounting for 95 to 98%. Veteran players, OGs and whales, haven't really moved. Inflow of old coins is under 5%, still away from the 5 to 10% sell-off zone. Also, leverage isn't that high. The ELR is only 0.17. This shows this wave isn't just driven by borrowed money. So we only need to watch one signal now. If one day old coins and whales start flooding into exchanges while leverage is also soaring, then it's likely that the sickle is ready to harvest. However, if old coins stay flat, then this rise can be judged as very healthy, meaning people are actually buying and not just performing. Now, today's latest data shows that USM2 has hit $22.6 trillion, which is a new high, meaning there's more and more liquidity in the system. This isn't just a number, it's a reshuffling of the entire financial environment. Historically, whenever liquidity increases, Bitcoin usually follows. Since 2008, the total money supply has nearly doubled, but the dollar's purchasing power has dropped 38%, and inflation remains high. In this context, Bitcoin will definitely become a liquidity-absorbing asset, which is why Trump is so keen on encouraging it. With more money and more bubbles, Bitcoin acts as a liquidity lever. Plus, active on-chain addresses are growing, showing that it's not just the price moving, but actual users are increasing too. But we should note this round of easing is different. It's mostly driven by government leverage, not by consumption or organic economic growth. So the risk of an inflationary rebound is very high, and it could even trigger financial risks. The logic is clear. If you want to know if Bitcoin will rise, watch 3 things: continued easing, the current cycle stage, and if people keep entering on-chain. Our headlines are always bad news, right? Let's talk about some good news today. After 3 consecutive months of capital outflows, today, at least from Binance's data, things are starting to recover. In March, stablecoins saw a direct net inflow of $2.5 billion. The previous trend of continuous outflows has now been reversed. You should know that from December last year to February this year, a total of $7.6 billion flowed out of the crypto world. This level, if we were in the last bull market, would be the intensity of a total capital retreat in the late bear market. As it turns out, since the end of March, the wind has shifted a bit, and from April until now, $10 billion has already flowed in. Binance's reserves have pulled back from $41.4 billion to $45.5 billion. That's an increase of $4 billion in 1 month. So Binance is still the leader, accounting for 68% of the total market. The largest liquidity pool is still Binance. Simply put, money is starting to return to the exchanges, and everyone is waiting for the right moment for that potential purchasing power. But the problem is that the strength of this wave of return isn't actually that strong. For now, it at most helped push Bitcoin up by about 1.8% in March, which is far from the strength needed to kickstart a major market move. All right, for today's top news story, we still need to focus on Iran. Don't get annoyed just yet, because this is indeed closely related to our wallets. Do you know why it suddenly dropped after hitting 70,000 yesterday? Iran submitted a 10-point proposal. To say the content is acting like a rogue wouldn't be an exaggeration, but it at least shows one thing. The window for negotiation is still open. So what the market fears most right now is this. They talk about fighting but don't, and talk about peace but don't settle. This stage of having expectations but no actual implementation is when risky assets are particularly prone to fluctuating wildly. You can see that we've had basically 0 operations on our spot signals for 2 months now. Right now, staying still and playing dead is more profitable than trading frequently.
Follow-up reports from AB Media, XLs, and AP on April 6th all mentioned that Iran has submitted a 10-point response proposal through mediation channels. The U.S. views it as a significant move, but Trump also clearly stated that it's not yet enough to truly resolve the situation. In other words, both sides are still in contact, but there's clearly still a distance to go before a formal ceasefire and agreed upon terms. He doesn't have a plan. I have the best plan of all, but I'm not going to tell you what my plan is. As the market bets on a possible ceasefire in the Middle East, Bitcoin briefly surged to $70,000, and risk appetite quickly rebounded. However, it failed to hold key positions, soon pulling back and triggering liquidations. This indicates that the current market is still in the stage of trading on expectations. Once expectations are shaken, prices will reverse, making it difficult for a trend to form.
Let me ask you a soul-searching question. What do you think is the most dangerous stage in the crypto market? Some would say it's the downward phase of a bear market when everyone is losing money, right? Everyone is guessing where the bottom is, thinking I must buy at the absolute lowest point, feeling like they've lost out if it's even $1 more. But what I'm telling you is that the wind has shifted now. You see, most retail investors are leaving, right? Mid to short-term and short-term funds are all withdrawing. However, look at the large institutions. When large institutions continue to increase their positions, even while in a state of loss, that in itself is a statement. They're not betting on a short-term bounce, but on a long-term plan, vying for future pricing power.
Strategy currently holds about 760,000 bitcoins at a total cost of about $58 billion. At current market value, that's about $51.6 billion, a paper loss of nearly $14.5 billion, with an average cost of about $75,644 per coin. Under these circumstances, the company still added about $330 million to buy 4,871 bitcoins. Meanwhile, Bitmine holds over 4.8 million ethereum, nearly 4% of the circulating supply, with a market value of over $10 billion. Both institutions continue to expand their positions at these low levels.
They give someone in Japan or Europe or Switzerland or New York City a bank account that pays them 10% with no volatility. And if you think that Bitcoin can power that, then you're buying our stock because we're a digital credit factory.
Strategy raised funds by issuing preferred stock with an annual yield of about 11.5% while maintaining a cash reserve of over $2 billion to cover interest and ongoing buying needs. Bitmine, on the other hand, earns about $200 million in annual yield through Ethereum staking, providing cash flow support for its holdings. The two paths are different in nature but share the same goal: to extend the holding period, improve volatility resistance, and make the doubling down strategy sustainable.
Besides the long-term positioning of institutions, the Bitcoin held by retail investors is now becoming less and less. Why is it decreasing? Just messing around, trading contracts and getting liquidated, right? Then getting harvested here and there, so the coins keep dwindling. Plus, there are more and more whales now. Everyone is scooping up chips from the market. So pricing power will definitely concentrate in the hands of institutions and Wall Street. Once the market structure changes, the trend will follow. Institutional positioning isn't like retail, where there's not even 3 months of patience. Institutions have patience for 5 years or more. Some top VCs can even stick with a project for over a decade before hitting a unicorn, so people only see the success, not the hard times they endured. Prediction markets are all fighting for users and pricing power. Even the biggest bear, Jamie Dimon, has started mentioning blockchain and stablecoins, but you can hear the bitterness in his tone. Right now, the hottest concepts in crypto are AI and prediction markets. Things like RWA, or the previously popular inscriptions and runes, are already yesterday's news. Today's prediction markets are essentially gambling. You see, vice and gambling are, in my view, most aligned with human nature, and prediction markets are just gambling in a legal cloak. Well, Polymarket suddenly announced a major upgrade. They raised $1.6 billion just for promotion. Its old rival Kalshi hasn't been idle either. They've started fundraising, acquiring, and merging to get on the balance sheets. So 2 paths are clear. One is the on-chain free market, the other is Wall Street's compliance system. Which one do you think will come out on top?
Right now, Polymarket and Kalshi are the 2 giants of the prediction market, with market shares of 47% and 34%. The other players have almost no chance of a comeback. Polymarket goes the on-chain route, offering freedom and global liquidity. Kalshi follows the regulatory path, gaining institutional trust. This isn't just competition, it's 2 financial systems clashing head-on in the same arena.
I think that, if you take a step back, a lot of the criticism and the hit pieces were really based on misinterpretations of what Polymarket was. And I think that it was difficult to take those at face value when...
Looking at Polymarket and Kalshi, they're practically handing out tissues in supermarkets to compete. What does that tell you? They're desperate for traffic and users. In prediction markets, users are everything. So, with this upgrade, Polymarket got smart and went straight for the big fish, institutions. One institution is worth tens of thousands of retail investors, right? Plus, it solves their security and settlement issues. It makes things much smoother for institutions. If they become regulars at the casino, the profits will be astronomical, right? Also, once institutions are on board, liquidity will stay on the platform. I think this is Polymarket's ultimate game plan.
More importantly, the platform is willing to clear the old order book during migration and do a brief maintenance shutdown, basically clearing the way for the new system. Short term, this creates friction, but it also shows Polymarket's massive confidence in handling liquidity after the upgrade. They're not betting on short-term hype, but that after the upgrade, the money and the trades will come back.
The prediction market is huge. Even calling it a trillion-dollar market is an understatement. Why? Because essentially any information can be traded or bet on. It fits human nature perfectly. Plus, the topics can be so diverse and fun. So, if you're looking to enter this space, I'd suggest not competing head-on with Polymarket and Kalshi, or you'll just get crushed. But there's one thing you must keep in mind. AI agents. If your prediction market is built specifically for AI, where humans are out and only AI agents bet, wouldn't that be a whole new game? Regarding crypto, I've always said it's an era of individual sovereignty. Simply put, it's a grassroots consensus, a consensus shared between you and me. A financial revolution started from the bottom up. In this revolution, you have traditional finance with their official mandates, their territory, and their power, the people who make the rules. Will they just sit back and take it? Of course not. So, you'll definitely see pushback, smearing, and a lot of looking down on it along the way. Who's the biggest short seller on Wall Street? JP Morgan's Jamie Dimon. This guy has always said Bitcoin is garbage and that digital assets aren't even worth mentioning. But now the tide has turned. For the first time in his letter to shareholders, Jamie Dimon actually included blockchain, digital currencies, and smart contracts.
According to Jamie Dimon's latest annual shareholder letter, blockchain, stablecoins, smart contracts, and tokenized assets have been explicitly listed as new competitive forces, alongside Block, Stripe, and Revolut. This means traditional banks no longer see them as concepts, but acknowledge they will directly impact core businesses like payments, clearing, asset transfers, and customer relations.
I don't know the answer, and I actually do the work. So now I'm like doing a lot of research while I'm writing the letter to answer the question, what are we going to do? Is what we did the right thing? Should we do more of it? How are we going to use it? AI or open banking or whatever the question is, debanking.
JP Morgan Chase itself is a deep participant. Its blockchain platform, HKEX, has achieved near real-time fund transfers, bypassing traditional clearing intermediaries with a target daily transaction volume of $10 billion. Currently, Mitsubishi Corporation, Qatar National Bank, Siemens, and BlackRock have already connected. This shows it is transforming blockchain into its own infrastructure.
Everyone, take note. Jamie Dimon has listed blockchain, digital currencies, stablecoins, and smart contracts as competitors. Although he's seen them and is ready to change, from a subconscious level, he's still in a state of confrontation. He still feels this is a life or death competition. Actually, looking at it from another perspective. If traditional banks could humble themselves, digital assets or blockchain technology could help them save a lot of costs. Think about it. If we follow the business logic of traditional banks, deposits, transfers, and bookkeeping, aren't these their most basic operations, right? From its birth until now, for over 10 years, not a single Bitcoin transaction has ever had an error. So if central banks worldwide use blockchain technology to solve this bookkeeping issue, I think they could lay off over 95% of their staff. Now think about it. Once that 95% of energy is saved compared to the electricity cost of Bitcoin mining, which one is more significant becomes self-evident, right? All right, let's look at the newsflash.
Hong Kong's stablecoin licenses were originally supposed to be issued in March, but the pace has clearly slowed down now. The market is no longer obsessed with who gets the first license. It's starting to see who can actually make compliance work. Simply put, it's not about speed. It's about implementation capability. The Ethereum Foundation has been continuously putting ETH into staking these past few days, with the total nearly reaching 70,000 coins. The message is clear. They don't want to live off selling coins anymore. Switching to supporting themselves with on-chain yields, starting a self-sustaining path. The US crypto bill has entered a critical window with heated debates over stablecoin yields and platform boundaries. Whether it passes isn't just a compliance issue, but a question of whether institutions dare to enter the market on a large scale. The momentum is stuck right here. The amount stolen in the first quarter of this year is less than last year, but the attacks haven't stopped at all. Private key leaks and contract vulnerabilities are still seen every day. To put it bluntly, it's not that security is solved, but that the losses aren't as devastating. Charles Schwab is preparing to launch spot trading for Bitcoin and Ethereum. Traditional brokerages are moving into crypto step by step. Real change isn't about slogans, it's about the entry points of trading being taken away. Whoever controls the entry point will control the next wave of traffic.
All right, it's a bear market. From our view counts and member growth, everyone knows the tide has turned. The crypto world is indeed cold, while the AI world is hot. But we must persist here because the cycle is right here. AI will eventually become like the internet, where you'll hardly even notice you're using it. So now I've started reading. I realized it's been over a year since I last sat down and properly read a book. What am I reading? I'd like to recommend this to you all. It's a small booklet, very brief, called The Bitcoin Mining Guide. Why would a liberal arts student read a book like this? Because it's not about teaching you how to mine Bitcoin. It uses many interesting charts and mathematical methods to explain why Bitcoin mining can't be overturned. Bitcoin's value, why won't it go to zero? Why is it that even if quantum computing arrives, you still can't do anything to Bitcoin? This book covers it all. So when you're at your lowest, you must go back to basics and ask, what is Bitcoin? Will the 21 million limit change? Are private keys still secure? Then you'll have full confidence in the next cycle. So let's learn together, work hard together, and slowly get rich together. All our member benefits are listed here. We hope you'll join as a member, support our channel in becoming more professional, and grind with us to slowly get rich. See you tomorrow.